In the tumultuous world of finance, where numbers often speak louder than words, a single indicator has been screaming warnings of economic gloom for an astonishing 212 consecutive trading days. The U.S. bond market, in its longest sustained alarm since at least 1962, has stubbornly maintained an inverted 10-year and 3-month yield curve. To those in the know, this ominous inversion is akin to an economic storm cloud on the horizon. This financial soothsayer, the yield curve inversion, has a track record that cannot be ignored. It has heralded the arrival of the last 8 recessions. Yet, amidst this sea of red flags, the American economy continues to defy expectations, sailing on with surprising resilience. This paradox leaves us pondering. Can we trust the yield curve's foreboding message this time, or is there something unique afoot in the financial landscape? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. In the ever-fluctuating world of finance, the yield curve inversion is the oracle we can't ignore. For over 7 months, it has been sounding a somber note, with 10-year yields stubbornly below those of 3-month bonds. Historically, this inversion has been an unmistakable harbinger of economic downturns, presaging the last 8 recessions. But in today's unusual circumstances, can we rely on this age-old indicator to predict the future? The incongruity between the yield curve's dire warning and the robust American economy is perplexing. While pundits and economists initially braced themselves for a recession when the curve inverted in October, the economy has not only held its ground but appears to be gaining momentum. The yield curve's predictive power seems to waver amidst the Federal Reserve's aggressive rate hikes since March 2022, which have elevated short-term rates to levels unseen since the early 1980s. Could this deviation from the norm indicate a unique scenario where the Fed's actions are driven by a quest to tame inflation rather than stave off a recession? Some experts even dub it the Nirvana scenario. The futures market anticipates the Fed's benchmark rate to end 2024 at 4.4%, significantly above the 2.5% considered neutral for growth. In traditional recessions, central banks typically reduce rates below this neutral level. However, the yield curve's influence extends beyond the financial realm. Its consistent track record has a psychological impact, potentially causing businesses and consumers to scale back their activities, convinced that trouble is imminent. Banks also feel the squeeze as the inverted curve reduces their incentive to lend, a situation that disrupts the credit system. While some financial forecasters, including those at Goldman Sachs, have tempered their recession predictions, many still foresee a downturn, with a 60% probability according to a Bloomberg survey. Additionally, the yield curve's early inversion precedes recessions. For instance, in July 2006, it inverted well ahead of the 2007 economic downturn. Campbell Harvey, the economist who pioneered the yield curve's use as a recession indicator, remains convinced of its predictive power. He suggests examining the average duration of inversion rather than the consecutive days, a perspective that reveals the current spell may not be unusually long. So, as we navigate this uncharted territory where economic signals clash, we must ask ourselves, is the yield curve's warning a reliable beacon in this storm? Or are we witnessing a unique economic phenomenon? Can we afford to ignore its message at our own peril? In a world where economic indicators clash with reality, do you trust the yield curve's ominous warning? Or do you believe there's something unique at play in today's financial landscape? Share your thoughts on the reliability of this age-old predictor in today's economic climate. Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.